So someone took on the risk then, and when the energy and gas prices started to shoot up, who was the loser in this scenario?
So there could be lots of losers.
Yeah.
If I am a retail electric provider and I've sold you power for $50 because you don't want to have the volatility, right? And so now as I'm the provider for you, so I'm on the hook, right? So I've taken on your risk, right? And so I got to make sure the way I make money is that if the actual price that settled is much lower than what you paid me for, right? As a retailer, I have the option of hedging that, right? So actually kind of going to market and finding a way to kind of cover that. Or I can say, no, I'm actually quite comfortable and I'm gonna wear the risk, right? And so then imagine a market like Texas where there's many retailers, big and small, and some of the small retailers didn't hedge, right? And then there could have been some, big major event like Winter Storm Uri in 2021, or pretend this is the same kind of market design, but in Europe, if they didn't hedge, right, they're in a lot of trouble and they're likely out of business, right? And then you lost your retail contract because they're out of business, and you got to go find somebody else that's going to now give you a new contract, and it's likely going to be more expensive because this price has gone up.
Well, there was a number of UK energy suppliers that did go up in smoke, didn't they, Danny? I mean, what was it, like 8 big ones?
Yeah.
But
does that make sense though?
No, it does. It does. But what actually happened is a number of these energy companies blew up because before we just used to have, energy was nationalized in the country. We had British gas essentially. And when the markets became deregulated, anyone can go in and buy and sell that gas in the market and try and create their own efficiencies and I guess actively trading. But a number of these companies, once the prices shot up, they blew up. But
it was Bulb, the big one that went.
Which was the big one?
Bulb,
yeah. But the UK market's set up in the way that any of the retail customers ends up being rescued. I'm not sure how it works, but they are protected from this happening.
And to kind of link that into something like Bitcoin miners, right? And to use an example is that when a Bitcoin miner is connecting to the grid in Texas, there's always a physical transaction, right? So they have the choice, and as being an industrial customer, that means a large-scale customer that's deemed to be sophisticated, so they can take on the risk of this kind of index pricing, is that they can connect to the grid and say, do you know what? I'm just going to pay the spot price, and I'm not going to do any hedge, right? I'm just going to, whatever the real-time price is, that's what I'm going to pay. Or they can say, I'm going to try and enter into a long-term fixed price hedge with some energy supplier, which is financial, right? So it's hedging their physical consumption. And I'm going to buy, for example, in Texas, I'm going to buy a 5-year, 24/7, so round-the-clock hedge of 10 megawatts. Let me just insert 1 megawatt will charge 1 megawatt hour will charge a 100 kilowatt Tesla battery 10 times, right? So that's just kind of a reference of what is 1 megawatt hour, so 10 charges of a Tesla battery. So they have a choice and say, I'm gonna make this hedge, and I'm gonna do say $35 for my hedge, right? So they've got 2 transactions again, the physical and then this financial. And so then in Winter Storm Uri, when which is kind of happening in Europe right now, where these prices went up. They have the choice now in saying, okay, I've got this, I'm a 10 megawatt miner, is I'm just going to turn down my facility, right? So I'm going to go to 0, right? Or they could provide some, ancillary services to the grid. We can touch on them a bit, but assume they just turn offline. Well, that means that their physical meter that they're going to get invoiced for is going to be 0. But they have this hedge, right?
And can they sell that back?
They can, or they can let it settle against whatever that real-time price is, right? And so then in 2021, that retail price went as high as $9,000 for a few days, right? And so you'll hear in the headlines that there was a lot of Bitcoin miners that got paid to turn offline from ERCOT, which is false, right? ERCOT doesn't pay them to turn off. Is that the miner made the conscious decision when they hooked up to the grid saying, do I want to transfer this risk and have a fixed price hedge? Because they didn't have to. And if the Winter Storm Uri came through and they just turned off, there'd be no payments to that miner. But they had this financial hedge, and that hedge settles against the actual real-time price, right? So $35 settling at $9,000 every 5 minutes for 3 straight days. So a lot of them did very well because they turned offline. So it wasn't like they gave power back to the grid, but they stopped consuming from the grid. So they actually energy that was needed across other customers across Texas. They said, you guys take the power, we don't need it. It's way above what we get paid to do Bitcoin mining, so we're gonna turn off. And then they got rewarded for making their financial hedges, right? So those are the two transactions. They turned off, and then they got paid for this hedge, which was, kudos to them for having that.
Yeah, fascinating. If you're taking out a longer position, say a 5-year position, do you tend to pay more because you're getting a stable price, or do you tend to pay less because you get the economies of scale of buying 5 years worth?
There's a couple parts to that. So first, there's a credit cost, right? And so it's saying like, you go to the bank and you say, I want to buy a $20 million home, right? And they'll be like, what's your credit? Right? If you don't have credit, they're like, well, why don't you buy a $200,000 home and we'll give you some credit for that, right? So the longer the transaction and the higher quantity, like you need to have some type of credit, right, for that. And you can pay for that credit, that they could say, we're going to charge you an extra $3 per megawatt hour, or we're not even going to sign with you. You need to go find somebody like a parent, right? Some other company to sign for you. So one is that credit matters, and it costs for credit, right? So like it's very challenging for startup miners to get long-term contracts because there's a credit cost to that, especially if it's a lot of megawatts. So that's the first part. It's credit, and the cost is different for everybody. The second part is that there is a forward curve for power across, in Texas. There is like one primary location, which is the most liquid traded hub that people transact on to make these kind of hedges. And so there's a forward curve for this that can go out 10 years. And a forward curve is the same thing as like an oil market. It's like it is everybody's best guess of the future. And you can make a bet on that and say, bullshit, right? And I'm gonna sell that, right? Or that seems really cheap, I'm gonna buy it. So like this is like the standard forward curve. However, there's really not many natural long-term buyers of power, right? So you think about, for Bitcoin mining is like, so if you're Bitcoin mining and you're producing this commodity, which is hashes, right? And you've got a whole bunch of them because you have all these miners and you're gonna be producing a lot. And you say, okay, I got all these hashes and they're gonna be worth a fortune because look at the price of Bitcoin and you should buy this from me, right? It's like, who's your buyer, right? Like who wants to buy a 5-year strip of hash rate that's delivered a certain amount every day for 5 years out? There's no real natural buyers, right? Mm-hmm. Same as power generation, which is like, there's a whole bunch of natural sellers because we mentioned like post deregulation, so around the year 2000, when they lost their rate payer, right, and had the market, there's not a lot of, like when you sign a residential contract for your house, right, you're a very small volume compared to a generation kind of facility, and you probably sign for 1 year, 2 year, but they've got 50 years of generation, right? So there's no real natural buyers to these large power contracts. Not a lot of companies. So typically, companies will accept less in the future for it. So you can have this, pricing curve that goes down because there's not a lot of liquidity in the market, and they'll take less for it just because there's not a lot of natural buyers. If that makes sense.
Well, yeah, because what it's making me think of is interest rates with regards to mortgages. Mm-hmm. If you want a 2-year fixed rate, you tend to get a lower rate than if you say take out a 5-year fixed rate, because you might be thinking, well, I'd rather have a 5-year fixed rate because I know what it is, I know what I earn, and I feel more stable. But you're going to pay a higher interest rate because the mortgage provider doesn't know where the interest rates will be in 3, 4, 5 years. So it's a different kind of hedge.
Kind of, right? Because like sometimes the interest rates in the front of the curves can be lower or higher based on kind of what behavior a government will want you to do. So for example, like during COVID, they took the near-term interest rates to near zero because they want everybody to spend. And so then your interest rates in the back were more expensive. And there's some times where they want the opposite and they'll kind of raise those. So